Hello everyone, welcome to your own channel Daily Commodity. So today's topic is about what is commodity futures. So let me remind you, if you have not subscribed to our channel yet, please do subscribe to our channel and press the bell icon to get all the notifications and updates from Daily Commodity. So in today's video, we are going to discuss on the topic commodities future and how does it work. Commodity futures are basically contract which are agreement to buy or sell a raw material at a specific date in the future at a particular price. The contract is for the set amount. It specifies when the seller and uh, agrees to deliver the asset. It also sets the price. Some contracts are also allowed to settle in the cash instead of delivering. There are basically three main areas of commodity like food, energy, and metal. We find the mostly popular futures related to food on sugar, wheat, and for the energy, we find it on the oil and gasoline. For metal, we usually see gold, silver, and copper. Buyers of food, energy, and metal will use the future contract to fix the price of the commodity that they are purchasing. That will reduce the risk that prices will go up. Seller of this commodity can also use the futures to guarantee that they will receive the agreed upon price. They can also remove the risk of a price drop. Price of the commodities, sorry for the background noise. Price of the commodity changes a weekly or even a daily basis. Contract prices change as well. That's why the cost of the gasoline and gold and every other commodity which has its future changes so often. Now let's talk about how do they work. So basically, if the price of the underlying commodity goes up, the buyer of the future contract will make money. He'll get the product at the lower agreed upon price and can also sell it at that time what would be the highest market price that day only it could be sold. If the prices goes down, on the other hand, the future seller will make the money. He can buy the commodity at the lowest market price and sell it to the future buyer at the higher, which is agreed upon price. If the commodity traders have to deliver the product, then few people would do it. Instead, they can fulfill the contract by delivering the proof of the product which is in the warehouse. They can also pay the cash difference between or provide the another contract at the market price. Next is commodity exchange. So there are various commodities exchange which are available in the world which will allow you to trade in commodities futures. The contract goes through the exchange clearing house. Technically, the clearing house buys and sells the contract. The exchanges make the contract way easier to buy and sell, and it also makes them fungible, which means they are interchangeable, but they must be the same commodity, quantity, and quality. They must also be same about the delivery month and location. How future contract affects the economy. So basically, companies uses future contract to lock in the guaranteed price for the raw materials such as oil. Farmer uses the future contract to lock in the sales price for their livestock or grain. Future contracts are also something which guarantees that they will buy or sell the good at a fixed price. They plans to transfer the possession of the good under the contract. The agreement also allows them to know the revenue or cost which is involved. For them, contract reduces a significant amount of risk. So here are some pros and cons of the contract. Firstly, talking about the pros, then this contract ensures that the commodity producer receives a fixed sales price comes when the harvest or selling time. If the price drop, then also the producer will not lose a lot of money. He'll still get something which he or she has agreed upon that price. Producers can also have the limitations on the risk which is involved whenever we see a huge price drop. Then producers can also make the better production plan. So this were the pros of the future contracts. Now let's talk about the cons. So in case of the cons, if the prices goes in the upward direction, then producers can also miss out on the considerably gains, because contract prices are already pre-decided and they are fixed. Trading into this kind of contract could be a very risky if you do not have a knowledge about the commodity prices and its volatility. How does it work? So it could be a risky process for you. Commodity prices are also influenced by the world event, that sometimes it may not be very easy to predict them. It depends on the emotions and market speculations, even when the demand and supply remains at the same level. So and there is one more con, that is the investment type is best left to the experts. So if you do not have understanding about the contract or how does it work, should you invest into such kind of contracts or not, so please do not invest into certain kind of contracts. Next is example. So there are various examples that you can take on the commodity future trading, that how does it affects the prices. There are also real case scenario. uh, so here we would be telling you about the one example, that is metal. So if you have noticed, the metal prices, it fluctuates in a very different way. So here we are going to talk about the oil. Traders take into account all the information about the oil supply and the demand, and also the geopolitical consideration, which affects the oil prices. If you take the assumptions behind that the oil prices would be affected by the economy so significantly, the prices will be impacted by various goods and services which are produced in America. For example, if the oil prices affects the gasoline prices, it will directly, because 54% of the gasoline price is dependent on the price of the crude oil. So a rise in crude oil prices will raise the pump prices as well. If we take the scenario of 2020 January, the world government began restrictions travel towards and closing the business due to the pandemic. Demand for the oil fell, and during the first quarter of 2020, the oil consumption was lower around 5.6%. So, these are some kind of the examples through which you can understand that sometimes it could be really hard for you to predict the next trend or what will be the so sometimes it might be difficult for you to predict the prices, and it is not a easy task. So always do your own research and then only predict. Always go for anything, any options, only after you have done your enough research and you know what you are dealing into. So that was it for today's video. If you like it, then please do like, comment, share. You can follow us on Instagram at the rate Daily Commodity, and don't forget to subscribe to our channel. Also, we have started with our new channel related to cryptocurrency market, where we try to upload videos related to Bitcoin trading and concepts related to the Bitcoin and every other cryptocurrency. We would be coming up with so many topics in near future. So if you want, you can go and subscribe to that channel. Link is in the description box. Thank you for watching.